Hi everybody, welcome to lecture 5. Now in this lecture 5, we'll be talking about spend method. It's not about spending, it's about investing. But the method which focus on S.P.E.N.D, we will review in our course outline. So in this lecture 5, we'll be talking about what we just mentioned, the spend method, and also look at what is the best time to sell a stocks and what are my final advice to investors, especially if you're first time. But overall, the key point is buy low, sell high. That's always been this strategy. And if you ever buy high, you need to sell higher. That's how simple it is. Let's look at what we have for you. Now, understanding spend method, it's about buying undervalued shares and selling overvalue. So there are 5 aspects that we're going to talk about. Smart money, the PE or price earnings ratio, return on equity, which talk about the profitability of the company. Net tangible asset, it's what the company has right now, the net tangible asset, something that you can really hold on to, usually cash and assets, right, like building. And finally, what do investors get during this experience that they have being a shareholder that is usually rewarded with cash or what we call dividend yield. Now let's explore this. Now, what is smart money? Smart money, if you've been following Trade VSA, this is synonymous with what we call the trading specialists, syndicates and investors, hedge fund and market makers. They are generally the big mover of the stocks due to the sheer size. Now, unit trust fund managers, EPF, those are not smart money. Now, smart money always have intention to shake out the first time buyer. So sometimes it's always good to follow the smart money. We always talk by following and tracking the price and volume. More about smart money in our later module. Now, this is a picture of George Soros, one of the best smart money in here. Now, do take note. Usually, smart money will appear on media, on TV to tell you that he is buying because of reason A, B, and C. But what's the truth behind it? Tell me. Do a smart money act at your best interest when he's buying? He will tell you, think very carefully. Usually smart money say something, they will do the opposite. So always be careful of the good news when it comes to smart money. Now, in our next second of our spend method, which is P, is talk about price earning, PE. It measures the attractiveness or how pricey the stock it is, and usually we obtain from the industrial consensus or company report or information website that you'll see on the financial side. Generally, we want to have the PE to be the average of the KLCI, which is right now 15 to 17 times, which means it's about 15 times or 17 times more expensive, right? And if you get something which is above 3-digit, 110, 120, then you will know this is more than 10 times more expensive. Always compare the PE with the industrial PE, and all things being equal, you want the PE as low as possible, so you are buying undervalue. Let's look at the next one, which is E, measure the managerial strength, or we call the profitability to the investor. It is important as an investor, we want to make sure we buy company that makes money, right? So we will ensure that in the medium to long term, we will have the same trend going for us. It also indicates that the company is able to generate profits, and the minimum requirement for ROE usually are the low teens or 10 to 12% in here. Of course, higher is better. Let me give you a clue. If you can get a company that is higher than the PE, let's say the PE is 15 times and the ROE is 20 times, that simply says that this company is generating enough profit to cover the priciness or the attractiveness of the company. That is something you should look out for. Now, the formula of return on equity is definitely net income divided by shareholder equity. Now, we'll turn our attention to N. Now, what is N? N stands for net tangible assets. That's right. It is the asset backing of the company, usually in the form of cash. So that's why when we look at company, we want to make sure a company generate enough cash from their operating activities. And usually we're looking somewhere between 10 to 15% of the cash coming out from the revenue. Having said that, if a company generates 1 billion revenue, okay, then you should see around 10% are the cash balances that usually remain in the company, because these are what we call free cash flows intended to use for paying dividend to you if you're an investor or refinancing a lot of the working capital. Having said that, we prefer to have NTA as high as possible. Generally, services has fewer assets, so we need to make some adjustment according to it. Now, next, we will turn our attention to what else? Cash. That's right. Cash is king, isn't it? So in cash, we refer to the actual money that is sent by the company to you as a shareholder. And usually they pay 2 times or 1 time, at least 1 time a year. Some pay 2 times. So depending on the strategy that you're taking, you might want to invest in companies that do pay good dividend, usually better than the fixed deposit that you get from the bank. And minimum we are looking for is generally 3%. Nowadays, the dividend are taxed at a flat rate of 10%. So do think about dividend, especially if you are in the senior or later age looking for some sort of yield. After all, at the time of this recording, a lot of our fixed deposit or the overnight policy rate are so low, less than 2%, that it's better to look for a dividend stock that pay at least 3%. And guess what? You will also enjoy a little bit of upside on the price gain if the stock continue to make earnings and you have bought it at the lower PE, let's say below 15 to 17 times. Take note of that. So we have completed the S.P.E.N.D method, S.P.E.N.D. Now let's take a look at something which is very close to me, is when do you sell? Now, if you follow the tenet of Warren Buffett for undervalued shares, he generally said that if he buy her shares, he will hold it forever. But in the new era of internet and market volatility, we have seen maybe it's good to take some profit, and like it or not, all our tools have certain screener that you will pick up new stocks and generally what we call new horses to ride. Maybe the old one is tired, so you can make a new purchase. Now, what to do when we want to sell a shares? Selling something is generally more difficult because sometimes we attach to it because of the story and the earnings and the management, you like it. So it's very hard. So it's always good to have a plan. A plan will include definitely the target price. What kind of target price are we looking at? Generally, we want to see somewhere between at least 15% return per year or 20 to 30%. That's a good point. And also do sell a share if it goes below the cut loss point. And those of you who want to know what are the cut loss point, you can use Smart Roby, the smart intelligent apps that will tell you the plans about that. And when the stock is overvalued, in the time of recording, we have seen a lot of rubber glove stock, like during the COVID and post-COVID-19, they were trading around 25 times PE. Now they are trading like 50, 60, 70 times. So this does mean it's overvalued. Because when a stock PE is overvalued, the earnings has to catch up. And when the earnings catch up, stock price may not move up because the PE will remain the same. And the fourth one is fundamental change in the company, where the company take up new joint ventures, new ventures that may not be aligned with their core competency, something that they are not familiar with, or decided to take up excessive loans to par down their capitals, which is not really a good thing, right? So those are some consideration. And the final one, fifth one, is the overall investment goal. So in the past, if you are been looking at some small cap stocks, if you're the younger age and you wanted to buy growth stock, and when you hit your mid age around the early 40s or 50s, you may want to adopt a dividend paying strategy. So some of this has already run and you want to sell some of your growth stocks and move into dividend stock. That is also another reason to sell your shares. Now, never ever get married to your shares. That's my final word. Now, of course, my advice to investor is always constantly monitor your stock and the trading target, because this will give you an objective, right, on the market, because not all things go up. They do go up and come down, especially the kind of market that we are seeing. So spend a bit of time to review your S.P.E.N.D rule, which we talk about, right, and record the gainer and losses every month into a plain notebook or Excel spreadsheet, so you will keep track of your portfolio. Now, last but not least, Another point we always talk about, always start small. All right. If you have doubt, maybe start paper trading or start paper investing. So let's see how you go for the 6 to 9 months with the market condition. Now it's okay to make mistakes because generally when we first started off, we tend to follow certain sifu, certain guru, certain stock pick, and we really don't know what we are doing, which is normal, right? But do take note, when you follow this sifu, follow them closely and take note of the reason why you buy and sell, and also record the winning and the losing. Because in the long run, if you look out for quality stocks based on the S.P.E.N.D method we talk about, which is S stand for smart money, P stand for PE, E stand for return on equity, N stand for net tangible asset, and D, dividend yield, you will have consistent return in the long run. Just like the goose laying those golden eggs, you will get golden eggs many times in a lifetime. So that's all I have for the lecture 5. Thank you for watching. I'll see you in the next lecture.